Hey everyone, and welcome. Something huge has just happened in the UAE's business world, a brand new corporate tax. But, and this is a big but, if your business operates in a free zone, there is a massive game-changing opportunity hiding in plain sight. So if you're in a free zone, or even just thinking about it, you're going to want to listen up. This one's for you.
Okay, let's just jump right in. As of financial year starting on or after June 1st, 2023, the whole landscape has changed. The new standard corporate tax rate is now 9%. For most companies out there, that's just a new normal.
Right? 9% is the headline, but it is not the whole story. Not by a long shot. For a select group of businesses, there is a clear path to a 0% tax rate. Now, this isn't some secret loophole. It's a very specific benefit designed for free zone businesses that can meet a really strict set of criteria. And figuring out how to do that is exactly what we're going to unpack right now.
So here's our game plan. We're going to start with that incredible 0% benefit. Then we'll get into the nitty-gritty of what qualifying income actually means. We'll cover the traps you need to dodge, talk about a crucial safety net, and then wrap it all up with how to stay compliant. Let's do this. I want you to think of this 0% tax rate as like an exclusive VIP club. The perks are amazing, obviously, but you can't just stroll in. You got to be on the list, and you absolutely have to follow the house rules. So the first question is, who even gets an invitation?
Well, the official term is a free zone person. Sounds a bit formal, right? All it really means is that your company is legally set up, incorporated, or registered inside one of the UAE's designated free zones. You know, we're talking about the big hubs like DMCC, Jaffa, or DFIC. If your business calls one of these places home, then congratulations, you're eligible to join the club.
But being eligible isn't enough. Here's your checklist to actually get that VIP pass. First, you need adequate substance. That means real people and real operations on the ground. Second, you have to earn qualifying income. We'll get to that in a sec. Third, you must not opt into the 9% tax rate. And finally, the compliance trifecta. You got to follow transfer pricing rules, get your books audited, and file a tax return. And let's be super clear. This isn't a buffet. You can't pick and choose. You have to nail every single one.
Okay, you're in the club. Awesome. Now you've got to play by the rules to stay in. And the number one rule is all about the kind of money you make. See, not all revenue is created equal in this new system. And honestly, this is where a lot of businesses could get tripped up.
So, qualifying income basically flows from two main streams. The first one's easy. Any money you make doing business with other companies inside a free zone. Simple. The second one's a bit more tricky. It's income you get from mainland or international businesses, but, and this is key, only if it's from a very specific list of qualifying activities. Things like manufacturing, logistics, fund management, you get the idea. If your main gig isn't on that list, that income just won't count.
Now, for the flip side. If there's good income that keeps you in the 0% club, you better believe there's bad income that can get you kicked right out. This is called excluded income, and you have to be so careful to steer clear of it. And the difference between what's safe and what's not is really night and day. The big red flags you have to watch out for are things like earning income from mainland real estate or revenue from banking and insurance services. These activities are the absolute no-go zones if you want that 0% rate. I want you to really let that sink in for a second. The rules here are totally black and white. If your company earns even one single dirham of this excluded income, it could trigger a disqualification for your entire business. And that means all of your profits for that year get bumped up to the 9% tax bracket. The stakes are just incredibly high.
Okay, after that pretty serious warning, there is a little bit of good news. The tax authorities get it. Sometimes a tiny bit of non-qualifying income might slip through. And that's why they created a safety net, kind of a lifeline, called the de minimis rule. But, and this is a big but, it has very strict limits.
Here's how that lifeline works. You can have a little non-qualifying revenue, as long as it stays below a certain threshold. And that limit is the lower of two numbers, either 5 million dirhams or 5% of your company's total revenue. Now let's be honest, for most businesses, that 5% is going to be the real ceiling, the number you've got to watch like a hawk. To put it another way, think of it like this. To stay safe, a whopping 95% of your total revenue must come from qualifying sources. That tiny little 5% slice at the top, that's your entire margin for error. It just shows you how disciplined you really have to be.
Alright, so you know how to get in and you know the rules of the game, but this benefit isn't a set it and forget it kind of deal. The final piece of this whole puzzle is the upkeep. It takes constant work to protect that 0% rate, year in and year out.
Think of this as your non-negotiable annual checklist. You absolutely must have audited financial statements. You've got to keep meticulous records that clearly show where your income is coming from. All your transfer pricing has to be documented and in order. And yes, even if you owe zero tax, you still have to file a corporate tax return every single year. These aren't suggestions, they're the price of admission to the 0% Club.
So there you have it. The 0% corporate tax rate is without a doubt a powerful advantage in the UAE's new tax world. But it's not a given. It demands that you know the rules inside and out, that you have strict controls, and that you are totally committed to compliance. It's not a gift. It's a privilege that has to be earned and then protected. So the real question is your business actually built to do that?